Welcome to Wall Street Week, the show of record for long-term investing. I'm Gary Kaminsky.
And I'm Maria Bartiromo. A busy and historic week for Wall Street and America. The Dow Jones Industrial Average finally smashing through the 20,000 number for the first time ever this past week. I was on the air with Stuart Varney the moment that it happened at 9:30 a.m. on Wednesday. And, of course, the market hitting new records during the very busy first week for President Donald Trump. The new president acting on nearly all of his campaign promises, signing orders at one Republican lawmaker called a dizzying pace, including actions on trade, immigration, and Obamacare.
Next week will be a true test for the stamina of this Trump rally with an onslaught of economic data, including the Fed statement, consumer confidence, and the U.S. jobs report next Friday. Plus, the president will announce his nomination to fill the vacancy on the Supreme Court. That's expected on Thursday.
Yeah, it sure is. Let's talk about all of this with TD Ameritrade's Managing Director of Client Advocacy and Market Structure and author of Essential Option Strategies. That's J.J. Kinahan with us. Also with us is Neuberger Berman Managing Director, Holly Newman Kroft. Good to see you both. Thank you so much for joining us. JJ, characterize what we saw this week and the impact on the economy.
Well, you know, normally talking about the 20,000 on the Dow, I would be like, the Dow is not really a great measure of the economy overall because it is only 30 stocks. But the important point was the Dow hit 20,000 at the same time the S&P and the NASDAQ all close at new highs. So there's an enthusiasm that is, I hate to use the word unbridled, but really has come through. You know, we were talking earlier, the Mexico news come out yesterday. Doesn't stop the market at all. There's so much optimism right now, and it really seems tough to stop. With all that said, of course, you know, people have to be a little bit careful here, and the one thing I would advise, particularly the retail clients watching, is don't go all in right now. If you want to go in slowly, and that's just something I think people have to be very careful of as the enthusiasm starts to grow.
You know, Holly, speaking of retail clients, you deal with ultra-high net worth clients, sophisticated investors. So I really wanted to know from you, when the Dow hits 20,000 this week, do clients call you? Do they engage differently? Does it mean anything? And let's talk in more general terms. What have your clients been saying to you since the beginning of the new year in terms of what they want to do as a result of the enthusiasm?
I think my clients, like general retail clients, are concerned the market's hitting new highs every single day, and they wonder, can this continue? When you look at the valuations, the long-term averages, the market's really pretty in line with long-term averages, so we're not concerned that it can't continue to move up. What we are concerned about is increased volatility. So like JJ was saying, you've got to be cautious. There will be entry points in this market. There will be pullbacks. That's normal in a healthy, functioning economy, and I think that'll provide the investor with a great opportunity to increase their exposure.
Yeah, but really what I'd like to see is what this all means to earnings. I mean, we all know that the one thing that drives the stock market is corporate earnings, and there are some analysts out there who think a 15% corporate tax rate is equivalent to a 20% increase in earnings. Are you buying it?
Well, I think the consensus now is about 12% for this year, and it's an aggressive number. It can happen. The devil's really in the details of where this reform is going to come out with Trump. I think earnings are going to grow, certainly. It might not be 12%. It probably won't be 20%, but they will be significantly higher. One
thing I'd like to add on that, Maria, is, you know, as I listen to the earnings calls, I think there's a different tone in what the CEOs are talking about, and to me that's one of the more important things. CEOs are if you think about the earnings calls 9 months ago, it was like, well, we think we can continue at this pace in this sort of economy. Now it's, we see growth rates. You know, I'll go back to Jamie Dimon on the JP Morgan Chase call, talking about the U.S. being a healthy economy, Europe improving, Asia improving, and I really feel like that's the tone that most CEOs have set. Now, some have talked about the strength of the dollar perhaps hurting them in the future, but I think the overall tone has been, we see growth opportunity in a way that we haven't heard in a long time.
You know, you both have joined Wall Street Week in the past, and we talked about the Fed because everybody talked about the Fed as it relates to the market. Does the Fed not, I want to have both of you, does the Fed not matter anymore? I mean, do you not have to pay attention to what is happening out of the Federal Reserve?
I think you have to pay attention, but the expectation is that rates will rise. They will be responsible in rising rates. The question is, will it be 2 times this year or 3 times this year? As long as they keep pace and they're responsible, don't do anything too quickly, I think the market will just continue to grow.
You agree with that?
I do agree with that, but I think there's something about what this year is. I will say the last 2 years, if you summarize the year, you'd say they were Fed-driven years. We are now in a policy-driven economy. The Fed has gone to 1B from 1A. They were always the 1A story. If you look at the probabilities from Fed funds, we're now out till May until we even have a 50% probability of a rate raise. It's a little bit under that at the moment, so they're not, there was nothing else to talk about, so to speak, because we didn't know what was going to go on. The president was on his way out. Now there's new policy. I think Holly said every single day something comes out that drives the market. This is the Fed is 1B. I don't think they're going to say that with Ms. Yellen in charge, they don't have a history of surprising the market necessarily. I don't think that's going to change. So, yes, it's interesting, but it's no longer the main story.
Yeah, and we should point out that there's a Fed meeting next week on Wednesday. Let me ask you, you said earlier, JJ, you want to go slowly into this market. I assume you mean selective picking in terms of where to place bets right now. Construction companies on fire on this expectation that the infrastructure that President Trump is going to implement will lift their fortunes. Financials on fire on the expectation that Dodd-Frank comes in and the regulatory environment helps their earnings. Have they gotten ahead of themselves? Would you buy those 2 groups, or where do you allocate capital right now?
I think, first of all, when I talk about, allocated, besides picking smart areas, the other thing that I want to make sure I'm clear about is not going 100% of your capital in right now. That's the bigger mistake that I think retail makes, rather than going in a portion of their investable assets right now. But to answer your question more directly, Maria, I really still feel financials are good. And the primary reason is because they touch just about everything else. And so with that, I think that that's the main area you still want to be focused. And the other one is because they are going to get such a break in the tax rate, and they were a late player in the game, is in IT. IT had a tough time, when all the other stocks were rallying at the end of the year. They really weren't participating as much. They sort of caught fire as the year started. And I think the IT sector, particularly those who are involved in hardware and software that's produced overseas, although that may seem a little strange because of some tariffs, but I think they're going to get a chance to repatriate a lot by the way,
don't underestimate what this infrastructure plan means for the banks or the XL pipeline. Somebody's got to fund this stuff.
Exactly.
So these private-public partnerships, that's going to be the banks that gets that bonanza.
Holly, are you guys at Neuberger overweight financials and technology?
We are. We are. We're overweight generally the U.S. economy, but getting back to what JJ said in terms of market timing and when to put your money to work, statistically it's very interesting. I learned preparing for the show today that the first February of a new presidential cycle, new administration, 80% of the time February is a down month. And so if February is a down month, which statistically we might see, it would be a really good time to increase your equity exposure overall.
All right, good. Excellent point, JJ. Holly, stay right there. Wall Street Week, we'll be right back.